Welcome to the deep dive. Okay, so you sent over the Valmont Industries VMI earnings materials.
Yes.
And looking through it, this quarter feels like, well, two different companies almost.
It really does. You've got this incredible performance, record margins actually, in their utility business.
The gold rush, yeah.
Exactly. But then you see the agriculture side dealing with some real challenges. Bad debt, softer demand.
So our job today is basically to figure out which story matters more, right? Cut through that noise.
That's the perfect way to put it. Because, despite the ag headwinds, VMI delivered a really clean beat.
Driven by margins.
Absolutely. It solidified that whole bullish narrative around infrastructure, even with everything else going on.
Okay, shit us with the numbers quick. Beat or miss, what drove it?
Big beat on the bottom line. Adjusted EPS was $4.98. The street was looking for $4.62.
Wow, okay. That's a solid beat, almost 8%.
Yeah, and 21% growth year over year. Revenue was $1.05 billion, just slightly ahead of the $1.03 billion consensus.
So revenue only up about 2.5% year over year, but earnings way up.
Exactly. Tells you everything. It wasn't a top-line blowout. It was internal execution, margin leverage.
Okay, so that modest revenue growth really hides the story in the segment mix. Let's unpack that. Infrastructure good, ag bad. Is it that simple?
Pretty much the picture, yeah. Infrastructure sales climbed 6.6%, hit about $808 million. That was the engine.
And ag.
Ag sales dropped 9%, down to $241 million. So that divergence really highlights how crucial the overall margin discipline was.
How much did margins improve overall?
Operating margin jumped 120 basis points compared to last year, came in at 13.5%.
So for every dollar of sales, they kept what, 1.2 cents more profit than last year? That's significant.
It is, and gross margin was up too by 80 basis points to 30.4%.
How'd they manage that lift when, a big chunk of the business was shrinking?
A lot of it was cost control. Management really leaned into organizational streamlining. Corporate expense, for instance, fell over 6%. Down to $25.1 million. They actually pointed out that's the lowest it's been in 13 quarters.
Wow.
So that operational efficiency, it just provided this cushion, showed they could leverage their scale even when things are uneven.
Right. Okay, let's drill into that infrastructure engine then, because that seems to be the whole investment story right now, specifically utilities.
That is the growth narrative. Utility sales specifically grew 12.3%. It was a mix, higher volumes and better pricing.
And the pricing, wasn't that related to something they did earlier with tariffs?
Exactly right. They took some actions back in Q1 to mitigate tariffs, and now that product is shipping, so the pricing benefit is flowing through. Smart move.
And that led to record profits in infrastructure.
Correct. Operating income for the whole infrastructure segment hit 17.8% of sales. Management made a point of saying that's an all-time record.
How would they get there? Just pricing?
It was a combination. Pricing, yes, but also pushing more high-value products and just a better cost structure overall.
And other parts of infrastructure contributed too, right? Telecom looks strong.
Yeah, telecom sales jumped 37%. Mostly quick turn orders, getting components aligned. Coating sales were also up, almost 10%.
But they're also trimming some areas. I saw solar sales were down.
Yes, solar is declining. They expect it to be only around 2% of total revenue going forward. They're actually planning to consolidate the reporting for it into another line starting in 2026.
So reinforces that focus, right? Doubling down on the core utility business that's clearly working.
Precisely. It's all about that portfolio pivot.
Which brings us to the big picture investment thesis. This relies on a multi-year spending cycle in utilities, doesn't it?
Absolutely. And the underlying drivers for that are, well, they're pretty powerful.
Like what? Give us the rundown.
You've got massive data center expansion, driven by AI and just general load growth. Then there's manufacturing onshoring, broader electrification pushes.
Plus just fixing the old grid.
And just fixing the aging grid, exactly. Market forecasts are calling for transmission spending specifically to grow at like a 9% compound annual rate through 2029.
9% CAGR. That's pretty visible growth, even if the economy gets choppy.
It's very visible.
So how are they meeting that demand? Capacity expansion? I know they mentioned brownfield projects.
Right. They're focusing on upgrading existing plants. Think Brenham, Texas, Monterrey, Mexico, rather than building brand new ones. It's faster, usually cheaper.
How much capacity did they add?
In Q3 alone, they added about $95 million in annual revenue capacity just in infrastructure, and more is coming in Q4.
Okay, here's the number that jumped out at me. The incremental margin on that new capacity.
Yeah.
They said well over 20% operating margin.
Yeah, incredible number.
How is that even possible? Like, why isn't everyone just jumping in to build transmission poles if the margins are that good? What's stopping them?
Well, management talked a lot about barriers to entry. This isn't like setting up a coffee shop.
Right.
It takes decades of engineering know-how. You need certified processes. And crucially, you need to be qualified by the utility customers themselves. They don't just switch suppliers for critical grid parts lightly.
So it's sticky.
Very sticky, which gives Valmont real confidence that basically demand is going to outstrip supply for a while.
And you see that confidence in the backlog numbers, too.
Well, yeah.
Up over 20% since the start of the year.
Yep, driven by utility strength. They also highlighted a big $65 million win for an extra high voltage project. Shows they can handle the complex stuff.
Okay, so infrastructure sounds fantastic, generating amazing margins. Now we have to balance that. How much damage did the agriculture side do?
Right. That's the other side of the coin.
What's the mood out there with farmers? And where did VMI get hit financially?
Well, ag is definitely in a slowdown. In North America, farmer sentiment is pretty soft. You've got record corn and soybean yields pushing down prices.
Okay.
But internationally, especially Brazil, that was the main headache late in the quarter. Credit got much tighter, government financing slowed down.
So farmers just stopped buying big equipment.
Exactly. Customers there just had to delay big capital purchases.
And that's where the financial hit came from.
That's where the bad debt expense came from. The segment booked an $11 million charge, mostly related to collections in Brazil.
Ouch. $11 million. How much did that drag down the ag segment's margins?
It dragged the reported operating margin down to 9.7%. But management was quick to point out if you exclude that $11 million charge, the margin would have actually been a pretty healthy 14.1%.
Okay, so underlying profitability isn't terrible. It was this specific collections issue.
Right, and they expect to get those issues financially resolved by early 2026.
Still, it's a significant hit to take now. So while they wait for Brazil credit to ease up, what's the plan in ag? How do they build resilience?
They're really focusing on the less cyclical, higher margin stuff like aftermarket parts and technology.
Makes sense. How are those doing?
Aftermarket parts sales grew 15% year over year. That's about $52 million. A lot of that driven by a new e-commerce platform they rolled out.
And technology.
Tech revenues, mostly their Accents 365 platform, grew 8%. What's interesting there is they're expanding the market by letting it connect to competitor pivots too, so it drives recurring revenue.
Smart. Okay, so bottom line then. Did the strength in infrastructure, those record margins, outweigh the $11 million ag headache enough for them to boost the outlook for the full year?
It did, yeah. They kept the net sales outlook the same, around $4.1 billion for the year. But they raised the adjusted EPS guidance, moved it up to $18.70 to $19.50. Midpoint now $19.10.
Okay, so that signals real confidence, doesn't it? That the cost cuts and that strong infrastructure mix can basically overpower the ag weakness.
Absolutely, and says they believe the momentum in the high-margin business will win out over those short-term ag headwinds.
And they stuck to the longer-term goals, too, that $25, $30 in EPS target.
Reaffirmed it. $25 to $30 in EPS and adding $500 to $700 million in revenue over the next 3 to 4 years. Still aiming high.
And the market liked it. Right.
Yeah.
Stock hit a new high.
Yeah, printed a new 52-week high on the day. It really felt like validation for that utility-led strategy. Investors seem willing to look past the ag issues as just cyclical noise that VMI is managing. Okay, so this is not financial advice segment. If we're distilling this clarity into, say, a high-conviction trade idea, how about a pair trade?
Ooh, interesting. What's the setup?
Something designed to capture the structural shift we've been talking about. Go long VMI short, a pure-play ag equipment company, probably one focused mainly on North America.
Okay, I see where you're going. You're trying to isolate that grid story, neutralize the ag cycle risk. Walk me through the rationale.
Exactly. The long VMI leg captures that unique, sticky, high-margin demand from the U.S. grid build-out. It's multi-year. It's validated by those incredible 20% plus incremental margins on new capacity.
It's structural growth.
Structural, high-visibility growth. Then shorting the pure-play ag OEM acts as a hedge against the global commodity cycle, the financing uncertainty. Basically, exactly the kind of risk that popped up with that $11 million Brazil bad debt this quarter.
So you capture VMI's execution on the infrastructure side, while hedging out the part of their business, ag, that's facing cyclical pressure, which is the entire business for the company you're shorting.
Precisely. You're isolating VMI's core infrastructure compounding story and betting against the broader, more volatile ag cycle simultaneously.
That's a neat way to frame the whole quarter's dichotomy. Okay, so quick summary. Record infrastructure performance, really driven by execution and adding capacity smartly. And on the other side, solid cost discipline, helping them navigate the pretty deep cyclical dip in ag.
That captures it perfectly.
Which leaves us with a final thought for you, the listener, to chew on. Management seems really confident, almost certain, that demand for utility structures will outrun supply for years. You've got that 9% CAGR backdrop for spending.
Right.
So if that's the case, and they're generating 20% plus incremental margins on growth,
Right.
what kind of price to earnings multiple does that kind of high visibility, high margin growth actually deserve long term? Something to think about.
Definitely food for thought. We hope this deep dive into the Valmont earnings landscape has given you some valuable perspective